Good morning, everyone. Welcome to today's webinar on Know Your SIP or Systematic Investment Plan. Myself, Bahaaar Anerao, Certified Financial Planner from Horizun Financial Services. In the next 30 minutes, I will be quickly taking you through the journey of mutual funds in India and helping you know your SIP, how the Systematic Investment Plan works. Also, I'll be sharing with you 3 of our best disciplined and managed portfolios at the end of this session, followed by question and answers. Please keep mics on mute and use chat for questions. I'm sharing my screen now. I hope it's visible to all. As we navigate the world of investments, SIP have emerged as a popular choice for investors looking to grow their wealth steadily. In this session, we will explore the benefit, mechanic, and strategies of SIP to achieve your financial goals. Now, introduction to SIP, your first step towards investing smarter. Let me take you through the history of mutual funds. Mutual funds in India started in 1963 with UTI, Unit Trust of India, making investing accessible. In the 1990s, liberalization introduced private and global fund houses, enhancing choice and competitions. UTI, Unit Trust of India, was the first to introduce mutual funds in India, followed by State Bank of India, which is called the SBI Mutual Fund. Now, SEBI is a watchdog for the mutual fund investments as well as the equity market. SEBI regulations strengthen investor protection and governance day by day, year on year. So the investors' money is kept safe into the fund houses. Fund houses as well as the financial planners or certified financial planners have to follow the ethics, code of conduct to manage the money collected from the depositors or investors. Today, SIPs and digital platforms have made mutual fund preferred wealth creation tool. It is a long-term investment, but people take SIP as a short-term investment. If you invest for a shorter term, returns will be minimal and the exit from the SIPs or the stoppage of SIPs is increasing day by day. So you need to understand that the journey is long-term for the wealth creation and not a short-term. Mutual funds have evolved alongside Indian financial growth, shifting from saving to smart investing. Now, a lot of our senior citizens have learned how to invest in the equity market through mutual funds. 5 years before, when I used to convince them that we need to invest some portion of our investments into mutual funds, they were never ready to invest, never ready to take the risk. But slowly and gradually, I have educated them. And today, most of my senior citizen clients are investing into mutual funds in a smarter way. They invest for a long term and they understand what are the market risks. And most of the money for the senior citizens, we invest into the balance category that is called a BAF, popularly known as a BAF. Next, we get many calls and many people come down to our office saying, "Sir, मुझे SIP चालू करना है." So when they say that मुझे SIP चालू करना है, तो as a financial planner, my first responsibility is to make them understand what is an SIP. So I immediately revert back them that आपको म्यूचुअल फंड में इन्वेस्ट करना है. They say नहीं सर, मुझे म्यूचुअल फंड में इन्वेस्ट नहीं करना है. म्यूचुअल फंड में तो बहुत रिस्क रहता है. I want to start an SIP. So in that case, I need to make him sit down and understand that what is an SIP. So in a layman language, I've explained on this sheet a bank investment versus mutual fund investment. Now in banks, we have options of recurring and fixed deposits. Recurring is done on a monthly basis. You give a standing instructions to your bank and on a particular specific date, the amount is debited from your account and invested in a recurring account. Fixed deposits, you go to the bank or you book it online. It is a one-time investment. Now, the same thing when you compare with mutual funds. Mutual funds has a recurring, which is called SIP, systematic investment plan, where the word investment comes, so it is market subject to market risk. Secondly, when you say a fixed deposits in a mutual fund, so it is called a lump sum or one-time investment. Coming down to the interest part, banks will give you a guaranteed interest. Means if you have taken a rate of interest of 7%, suppose for the next 5 years. So for the next 5 years, you're liable to get, as per the RBI policy, 7% guaranteed. There will be no change in the rate of interest. When this comes to the interest part with mutual fund doesn't have any interest thing, fixed thing. It is a returns on your capital which are subject to market risk. As the market grows, your investments will grow, the returns will go high. If there are corrections in the market, the returns will be fluctuating. So there is no fixed pattern. In mutual funds, instead of interest, they pay dividend, but also the dividend is taxable, and also there is no fixed dividend. Coming down to the tenure, in banks, you fix a tenure for recurring, you take 12 months, 24 months, 36 months. Also for fixed deposits, you have a maximum term of 10 years with the bank. If you ask State Bank of India to book an FD for 15 years, they will say no, maximum tenure is only 10 years. Beyond that, you need to come and renew the fixed deposits. The same way, the tenure available with mutual funds, basically people call it short term and long term. If you're investing for short term, it is within 1 year. And if you're investing for long term, there is no definition for long term. You can invest as many or indefinite years of your investments as long as you wish. Whenever you want to withdraw the money, it is called a redemption option. You can go for the redemption option and take out your money. Now, the tax exemption is income limited with the banks. Tax exemption is income limited to INR 5,000 or 10,000. For senior citizens, the slab is on a higher side up to 50,000 rupees per annum. Coming down to the taxation, mutual funds enjoy a special taxation, whereas banks, the taxation is as per your income slab. After these exemption limits are over, it is as per your income slab. Whereas with mutual funds, you have a special taxation. Special taxation means you have a short-term taxation and a long-term taxation. Short-term taxation is you will be taxed on 20% on the profit amount. Suppose you have invested 10 lakh rupees and the profit has gone to 12 lakh rupees. So on the 2 lakh rupees, you will be taxed at 20%. But there is an exemption limit of 1,25,000 per annum for the profits from mutual fund as well as equity markets. When you say long term means completion of 12 months of your investment. If you withdraw the money, again, the taxation will be at 12.5% on your profits after the exemption of 1,25,000. Next, the 90 rule in stock market. The rule of 90 in stock market usually refers to 90% of new investors lose 90% of their capital within their first 90 days. We are trying to first slide, we were showing you the difference between a bank investment and a mutual fund. Now, this slide, we are trying to explain you the difference between a stock market and your mutual funds. So when a person, if he's a new person to the stock market and he starts with his investment, the basic rule of stock market says that 90% of new investors lose 90% of their capital within their first 90 days. So this is a warning, 90-90-90 trading rule. This happens because lack of knowledge, emotional trading, and poor risk management. Whereas what are the benefits if you invest through the mutual funds? Benefits of investing through mutual funds into the stock market. Firstly, you get a professional management. Professional management means when you invest your money, the money is routed through a fund house. There are different fund houses in India, almost 40 to 45,000 fund houses are there. To name the fund houses, the big fund houses are SBI Mutual Fund, HDFC Mutual Fund, ICICI Mutual Fund, Birla Mutual Fund, Franklin India, DSP, and a lot of mutual funds. So all these are professionals. They have a fund manager who manages fund on our behalf. Basically, mutual fund is a pool of money from the investors. Suppose 100 people are pulling the money to invest into the mutual funds. Then the fund manager takes the decision how to invest this money into the stock market. So it is his expertise, his guidance, which invests our hard-earned money into the stock market with his expertise. When you invest into a share market, if you have 1 lakh rupee to invest into a share market, so if you go and buy a particular script, so there is a limit of buying one or two company shares or three, not more than that, as the values will be too high. But when you come with that 1 lakh rupee into a mutual fund, so mutual fund, the first thing happens that your risk gets diversified because your 1 lakh rupee is invested across the industry and different sectors of the mutual funds. So the very important thing is diversification of risk. Secondly, in mutual funds, you can start with a small amount of SIP, 1,000 rupees per month, which can grow gradually. Also, you can make a top up, or as your salaries increase every year, you can increase the SIPs. Again, the liquidity in mutual funds is very easy. If you go for a redemption, subject to the taxation part, within a span of 4 to 5 days, the money is credited to your bank account, working 4 to 5 days. Again, it is a long-term tool for wealth creation. Now, there are different type of investments through which you can invest into mutual funds. The first one is the SIP, the popularly known as systematic investment plan, wherein every month you start putting a small amount and gradually it increases over the years and makes a lump sum corpus at your retirement or your targeted short-term, medium-term, long-term goals. Second is a systematic transfer plan. When you say a systematic transfer plan refers to, or to get it to understand a systematic transfer plan, I'll give you an example of a bank. Now, banks have two types of account. One is a saving account, second is a current account. So saving account, you get some part of interest on that. Currently, I think it is 2.5, but a current account never earns any interest. Same way, systematic transfer plan is a current account of mutual fund, to understand in a layman language. So a systematic transfer plan, what it does, suppose you have 1 lakh rupee and the markets today are really high. You don't want to take the risk of investing the 1 lakh rupee at a one go in today's NAV. So what you can do, you can park this money with a mutual fund current account, which is called a liquid fund. Once you park the money into the liquid fund, you can give a standing instruction, like as you're recurring with the bank, that every month 10,000 rupees should be debited and credited to so and so fund account. That can be a large cap, that can be a mid cap, small cap, whichever fund you select. So over a period of next 10 months, this amount from your STP, systematic transfer plan, liquid account, will be transferred to the respective fund which we have selected. So this gives you an option of low risk, and the risk will be spread through 10 months. Then the last popularly known is the systematic withdrawal plan. As the SIP is becoming popular, the second option is the SWP. Day on day, we are getting calls from client that I want to do an SWP as suggested by my bank. But people are not understanding systematic withdrawal plan means you will start getting the returns immediately from the next month. So systematic withdrawal plan is basically for a person who is in need of money on a month basis and not for the earning people. Suppose you create a corpus of 50 lakh rupees through SIP. At the age of 50, if you decide I want to take an retirement and I want to start my withdrawals. So that's where the role of systematic withdrawal plan comes. From your 50 lakh rupees, you say suppose 12% you want to withdraw. So 12% is around 6 lakh rupees. So 6 lakh rupees divided by 12, 50,000 rupees will be paid every month from your capital, which is with mutual funds. So out of 50 lakh, first month the withdrawal happens of 50,000. Balance left with the mutual fund will be 49 lakh 50,000. So you will keep getting the market benefit on the left out amount with the mutual funds. So that way, within a year, you will withdraw 6 lakh rupees, but 44 lakhs rupees is left in the market, stock markets, which will earn you some returns. This way, the systematic withdrawal plan works, and it is advisable only for the retired or who is in need of money today. Now, the types of mutual funds. There are various type of mutual funds, and this sectors, we as an Indian are having the best sectors in the world. Other developed countries, if you see their stock markets doesn't give them so many sector options. They have maximum two sector options. But India as a growing economy, we have the maximum sectors where we can diversify our investments. That's the reason the foreigners, foreign institutions are pumping in a lot of money into our mutual fund industry, into our stock markets, ultimately to earn higher returns. Now, what is the purpose of investing in India? Because the risks are diversified across various sectors. Now, coming to the type of mutual funds, the first we have the large cap, which are called the blue chips. Now, blue chips are the grown companies where your money will be safer. So normally the percentage of large caps is up to 90% is invested in the stock markets, and 10% of your investors are compulsory invested into the government securities. Coming to the high risk, where the returns goes up to 35, 40, 45% are the small cap category. Small cap and mid caps, they are the most riskier funds to invest. So basically, while investing, we see the risk appetite of the client, explain them that these are the high risk funds. So when the markets are performing well, they will give you the highest returns. But vice versa, when the markets are not performing, they will give you the most worst returns over a period of that bad patch. Then we have the value category. In between, we have the large and small caps. We have the multi cap and flexi cap. So it is a combination of large caps and small caps. When a company grows from a smaller thing in a layman language to understand, a startup company is there. A startup company, when it starts, the first initial 2-3 years, they are ready to take any kind of risk to sustain in the market. Once they sustain in the market, they can be taken as a multi-cap. So multi-caps, now they are stable in the market. So the risk-taking ability will be little lesser than when they were into the new market. And once from the multi-cap, they are grown, they will go to the next level, that are the large caps. Large caps, they will become the blue chip. For example, in a layman language to understand, Tata, Birla, these are all Reliance, these are all grown, settled business. Now they will not take any kind of risks to spoil their brand name. They will keep their brand name intact and then only take the risk in the business. Now, coming down to the value funds. Value funds are also the riskier funds. To explain value funds, now the fund manager who takes a call, he has selected XYZ company, but today the company is not performing. But he can see the companies have got good projects. So within a span of 3 to 4 years, if they get a good business, so this business is going to be profitable over a period of time. So these are the value funds, they are riskier. To give an example, in 2016, we invested with ICICI Value Discovery Fund. From 2016 to 2020, it didn't perform well. It was at par only. Investors used to keep on asking what we have to do. The funds are not moving. The funds are at par. Sometimes it goes negative. But the scenario changed post-COVID. Post-COVID, the rally prior to COVID from 2016 to 2020, the rally was of the quality funds. But in the COVID, the rally got changed to the value funds and the value funds started performing. To give you an example, a person who has invested 1 lakh rupee in 2016 was at par till 2020. But by the end of 2022, when the stock market bounced back, the returns of 1 lakh went up to 10 lakh rupees within a span of 6 years. So this is the power of compounding. This is the power of investing into a riskier sectors. Again, the sectoral funds are infrastructure funds, then digital marketing funds. These are also the high risk funds. So before investing, we take the client's permission. We study the risk appetite of the client and then only we suggest. BAF, Balance Advantage Fund, these are the best funds to invest for the senior citizens who are looking for low risk into. The balance fund normally has a 70% equity exposure and 30% is into government securities. So whenever the market corrections happens, at least 30 rupees are in government securities. Safe word I cannot use because there is no safe word in mutual funds. Then the last category comes to ELSS. ELSS is your equity linked saving scheme. These are the tax saving. Normally, if you buy this ELSS, you get a ATC deduction under this. So whoever wants to take a tax benefit can invest in ELSS, but there is a lock-in period of 3 years. Before 3 years, you cannot withdraw the money if it is a one-time investment. But if you book an SIP month-on-month basis, then it is a lock-in period of 6 years. Till 6 years, you cannot withdraw the money because it is first in, first out. Now, what we do with the mutual funds, we do a portfolio management for our clients. Most of us existing clients have this benefits of our portfolio management. We also have an app, my wealth app. So in that, on a day-to-day basis, people can check what are the market returns, how are their portfolios managing. When I say the word portfolio management, and I've shown different coins, the houses in different levels. So it means that a smaller house represents it's a large cap. Then the center one is a small cap. When you come to the more coins, it is a balance category. So this way, across the fund houses, we invest and try to minimize the risk for the clients. So when the markets are not performing, the portfolio doesn't go in a worse situation.
How much of your money should go into equity and how much into?
Now, this is one rule, basic rule before you invest into the stock markets. There is a rule called 70-30. So I'll just take you through this rule.
Debt. Here's a simple rule that can help you balance both. Hi, I'm Bahaaar Anerao, certified financial planner at Horizun Financial Services. To decide your ideal balance, just use this simple formula: 100 minus your age. Let's say you're 30. That means 70% of your investments can be in equity and the rest, 30%, in debt. If you're 50, it becomes 50-50. Younger investors can take more risk and aim for higher growth, while older investors should focus on stability and consistent returns. But remember, this rule is just a guideline. The right ratio depends on your goals, risk tolerance, and life stage. That's where proper financial planning makes all the difference. If you want to know your ideal mix between growth and stability, connect with me, Bahaaar Anerao, certified financial planner. Let's build a plan that grows with you.
Thank you. Now just have a look at the SIP landscape, current book size and growth. Investments are coming on a huge into the mutual fund industries. There is a quick summary. The data has been downloaded from the mfindia.com. It is the Association of Mutual Funds in India. And secondly, from the Money Control, which gives your daily updates, again from the ET market. Now coming to the total mutual fund AUM, 80.23 lakh crores as of 31st December. This is the MFI data. These are the investments into the Indian mutual funds. Now SIP AUM or the book size. SIPs are on month-on-month basis. So month-on-month basis, total SIP count is 16.63 lakh crores as per the MFI and ET data. Coming to the monthly SIP inflow, approximately 31,000 crores money is coming into SIP on a month-on-month basis. New SIPs in December, it was approximately 60.46 lakhs as per the data of MP and ET. The major problem is SIP stopped. When you see new SIPs are approximately 60.46 and SIP stops are 51.57. So if you take a difference, only 10 lakh rupees is the actual figure. When you say out and in, the total difference comes to 10 lakh. Here is the problem, and you can see the next SIP stoppage ratio, approximately 85%. This happens because the investors are not educated. They invest into the markets for the short term, and as they see the returns, they exit, or as they see a loss, in that scenario also exit. Now we are maintaining the portfolios since 2016, so almost 10 years. Till date, we have guided and educated our client. So even if the portfolios are going negative, they have a discussion with us. And if in a worst scenario, we shift. So it is called a asset reallocation strategy. If a particular fund is not performing, we take a look for at least 2 years. If it is not performing, so whatever amount is invested, we leave it there. We stop the SIP and we do the asset reallocation. Asset reallocation means the existing SIP is stopped in the underperforming fund, but the funds are left over there only, and the new SIP is started in a different sector or a different fund. Now, contributing SIP accounts are 9.79 crores. So this is a huge figure of the Indian mutual funds. As I said at the starting of my presentation, I will be sharing some portfolio snapshots. So this is an example of a portfolio which is managed and disciplined by us. And the investor has been stayed continuously invested with us for the last 7 to 8 years. Okay, now coming to the portfolio snapshot, he has made a lump sum investment of 2,27,800. When I refer to a lump sum investment means in between his journey of 7 to 8 years, sometimes he has made a top up. Top up means he has got some extra money. He has called my office that I have some X amount of money which I want to invest. When we get a call, then we study his portfolio and accordingly I tell my staff to book the order in so and so funds. So this is a top up. Lump sum means it is a top up made by him in a journey of 7 to 8 years. His SIP investments is around 1 crore 19 lakh 94,398. So this is the big ticket size SIP which was started. So through SIP, he has created 1 crore 19 lakh 94,398. Now the net investment is around 1 crore 22 lakh 22,198. And just come and see the market value 2 crore 40 lakh 70,146 within a span of 7 to 8 years. Coming to a CAGR of unrealized gain 18%.23. This person has consistently invested. He has taken our guidance and he has never stopped any of his SIP even during the COVID times. Now explaining you the rule of stock markets and why you should stay invested in the bad markets. Now there are 4 cycles of the market. To complete the 4 cycles, normally it takes 6, 7 or 8 years, which I was referring as the quality market as well as the value. Currently, the rally is of the quality funds. That's why the small caps currently mid caps are not performing. They're at par or little into the negative. But this is a good time for the youngsters who have already invested into the small caps. Day on day basis, I'm getting calls from my existing youngsters who have invested in Nippon small caps that the NAV is negative. I said this is the good time because the NAV is negative means you are making a unit allocation, good amount of unit allocation. So maybe when it bounce back, the market bounce back from the quality rally to the value, this will give you good returns. So this is one portfolio where the consistency you can see. If you maintain a consistency, you can create good amount of wealth. Now the second portfolio, it is a lump sum investment of 13,67,900. SIP investment till date is 66,12,450. Switching and sweeps. When I mean by switching, this I refer to the systematic transfer plan. I explained what is a systematic transfer plan, the current account of the mutual fund. So this client has made a switch in and switch out. So through that, he has invested around 22 lakh 74,836. But in this folio, he has made a redemption of 10 lakh 8,963 and a switch off of 17 lakh 48,598. Currently, the investments are standing for 74 lakh 97,000 and the market value is 1 crore 13 lakh 84,959. Now you can come down to the CAGR of unrealized gain. The CAGR is 14.79. So you can see the difference in the previous portfolio. There was no redemption. 7 to 8 years were continuous. But in this portfolio, you can see there is a redemption. So as there is a redemption, you can see the returns have affected and the returns have come down to 14%. So still a good return. This is the last portfolio. In this, the client has invested lump sum amount more. So around 94 lakh 51,900 into the lump sum amount, which is a one time or a top up. SIP investments are on the lower side. So the SIP in this case is on a smaller ticket size. So 27 lakh 59,075. The switch-ins are also made in this, but there is no redemption in this portfolio. He has taken a dividend. Earlier, dividend was tax-free. Now the dividends are taxable. So hence we have switched him from the dividend mode to the growth mode. There are options that you can change the dividend option to growth. Now his net investments have 1 crore 13 lakh 31,651. Market value as of today stand to 2 lakh 35 2 crore 35,000 2,664. So even with a lesser SIP, this client has made one-time investment more compared to the SIP. The first portfolio we saw wherein the one-time investment was less and SIP ticket size was big. So both portfolios, if we compare, this also has given us CAGR of 18%. So these are the actively managed discipline. Now we can come over to the question and answers if you have any. I've finished with the presentations.
Awesome presentation, Bahar. It was really great. Good insight, good knowledge.
Thank you, sir.
Many of us wasn't aware of the difference between FD, RD, and SIP, right? Your
Yeah,
your presentation made it very clear to us. Thank you so
yeah.
much.
Thank you, Ravi sir. Ravi sir is our current investor from last 20 years. We had a good investment journey with him. Okay, now these are my office details. My office is open from 10 to 6. We are located at Kandivali's Lokhandwala. And you can follow us up on the following social medias. We are active. Last 6 months, we have started this process. So we are active on the social medias. Also, we have recently started the new YouTube channel wherein we share some educational videos. So you can have a look at that.
So, just to add on, thank you, Bahar.
Yeah.
This was really insightful for all of us, especially people we are working in finance company, NBFCs and banks. But sometimes we really lack this kind of simple knowledge, but end up, investing our money in wrong platforms. So thank
Yeah.
you very much. It was really required.
Thank
Thanks a
you.
lot.
Hey, hi Bahar. Good
Hi.
morning. Praveen Tendulkar over here. Nice to see
Hi,
you
Praveen.
virtually after many years. I started my investment journey with Bahar way back in 2005. I think so
With
that's the
you.
first time we met. And yes, obviously that time the focus was more on the secure investment. But
Yeah.
yeah, nice to see you conducting a session around, I would say, systematic investment plan and educating I would say, the investors. Thank you very much.
Thank you, Praveen.
Welcome.
Welcome. Anyone has any more questions or we will end with the session? Thanks everyone for the participation. For my existing clients, a big thank you for your support. Looking forward for more interactive in this.
Thanks, Bahar. Thanks for your guidance.
Thank you, sir.
Thank you.
Thank
Yeah,
you.
your guide. To be honest, your guidance has made a lot of difference, right?
Thank you, sir.
If I say that I started my journey for 20 years back, right? My main plan was to buy a new house, and your guidance with the SIP, right? My major portion of my new house, the investment came through the SIP through your guidance. So
Yeah.
I'm really grateful and really thankful. Thanks to all the help you have given me for this many years.
Thank you, sir. Thank you. Thanks a lot. Okay. Thank you.